Okay, I think we'll probably be able to breeze through and finish the PowerPoint for two reasons. One is the next couple of slides are not that complex, and then the second reason you'll see and hear when we get there. And then we'll have one more video or YouTube that will go through a couple of the loose ends and other big picture items that I want you to come away with in corporate tax operations vis-a-vis Chapter 16. So you'll wait for that, but this should be a relatively short one. This one deals with compliance issues, tax returns that are required. Corporations, these are again C corporations, must report on Form 1120. And when we get there, just to tell you this, the future scenes to be encountered in this course is when we get to the S corporations, it'll be a Form 1120-S. One would think that we make this one -C, but we don't. It's the original 1120. Small corporations do what's called a Schedule M1 within this form. Large corporations do a Schedule M3. We're going to take a look at that, or look at what this Schedule M's are all about. But basically, this is what they're telling you right now. What they're about. They're about this. They are showing the book tax differences to the IRS and explaining them. Let me say that again. It's going to show the book tax differences and explain them to the IRS. And the reason for that, you usually love to have fun with this in class and ask what's the reason. So you might want to stop the recording and think of it yourself. But the reason for it turns out to be, if the IRS knows these book tax differences, they now have a little bit of an inside clue as to audit issues. For example, we just had one where we had a book tax difference based on Section 351, which we get into in the next chapter. And so we had to explain it on an M1 adjustment or M3 adjustment as a difference between Section 351 and GAAP, because GAAP recognizes the issues involved in Section 351 differently than tax. For tax purposes, it's tax-free, and in GAAP, it's recognized as income, in our particular case anyway. Well, that recognition of that on the tax return, which we had to do, gave the IRS a clue, and they pulled this return for audit. And the reason they pulled it is they want to make sure that we did 351 correctly, that it was indeed tax-free. We're not done with that one yet, so that probably answers your question as to whether it should be tax-free or not. Okay. Corporate tax returns are due 2.5 months after the close of the tax year. Remember, individuals are 3.5 months, so this is 1 month earlier. There is automatic 6 months extension, which for calendar years means 9/15, and we just got finished wrapping up those this past week. Consolidated tax returns are not really covered in this course, but that's what you see here. They're essentially affiliated groups. So your parent subsidiary is your typical consolidated returns, where it's all reported on one return as opposed to parent reporting differently than the sub. This is what a Section M1 or Schedule M1 looks like. M3 is the same concept, but just blown up into many additional lines. And let's just take a look to see how powerful this is to the IRS. What they tell you to do is look at your books and records and see what your net income was and put that here. And now, what are the differences between this number and this number? This turns out to be taxable income per the return, using all the nuances that the tax code allows for income recognition, expense recognition, or limitations for C corporations. And the result is that going from point A to B, you wind up showing the IRS a map of all the temporary or permanent differences that are occurring between one set of income expense recognitions, that's GAAP up here, and the tax code here. Now, it all may be perfectly legitimate, and most of the time it is. But what the IRS does is they get a glimpse of the things that are being reported differently in order to see whether or not there's something that catches their eye. And in particular, what catches their eye is, amongst other things, but to give you some ideas, certainly would be lines 7 here, where it's income recorded on the books but not on the tax return. So you've got to explain it. And as you can see, could be just simply tax-exempt interest. That's easy, and the IRS won't necessarily be running to audit because of that. But they ask for a schedule of what the other items could be if there are more than one, if it's more than just tax-exempt interest. And that gives the IRS pause to see if they need to have any concern. Similarly, very similar concept is over here. Expenses recorded on the books this year, not deducted on the return. Well, that's not a problem, actually. So I hit the wrong button there, but let's go back. Here it is. This is the one, line 8. Deductions on this return not charged against book income. Again, these are, you're saying we took deductions that we couldn't take for financial statement purposes, and they're very interested in what these are. Depreciation may be easy to explain, but there may be a bunch of other items which are not deducted on the financial statements but are deducted on the tax return, and the IRS wants to know why. Just for the record, so that you don't go out to the job site unprepared, but federal income tax is deductible for financial statement purposes. It's not deductible for income tax purposes. So the tax that you pay to this federal government is not a tax deduction itself. Notice it says federal income tax because indeed state income tax is deductible for the federal income tax. It is deductible. And the rest of these line items are just these adjustments, permanent, temporary adjustments between book and tax. Okay, enough said about this, I suppose, but it's a very important schedule to be cognizant of when you're preparing financial statements. And that's why it's one of the better accountants out there for preparing financial statements is someone familiar with the tax law, then the differences between that and GAAP. Very important part of the picture to know what's going to wind up on these adjusting schedules, whether it's M1 for the smaller companies or M3 for the bigger companies. Like individuals, corporations need to pay tax on the pay as, you remember this expression, pay as you go scheme. So just like individuals have to do that, corporations have to do the same thing. So there's rules about installment payments when they're due during the course of a year. There's penalties if you underpaid as you go here. And there's some safe harbor rules similar to individuals for corporations to make their estimated taxes during the course of the year. One difference between the individuals and the corporations is that corporations have to make their final payment on December 31st, 12/31. Individuals get till January 15th of the following year. Not many days, but an important difference not to forget that corporations don't have that extra 15 days in January. All right, let's see what we got here. Required annual payment, 100% of tax liability on prior year return. That's one of the safe harbors. Neatly enough, just like, or not like individuals, and this is not very important to remember as well, because it's not like individuals. On individuals, this 100% of tax liability works even if it's zero. So if in 2014 an individual had zero income tax liability, their estimated tax requirement for 2015 is also zero. Not so with corporations. If your tax liability was 0 the prior year, then you got to use some other safe harbor for estimated tax payments in the current year, which could be 100% of the current tax liability, or using the estimated 100% of this year's liability using an annualized method. That's very similar to individuals. Rules for large corporations: $1 million of taxable income in prior 3 years. If that's the case, if they've been running that kind of taxable income, and in today's world that's not that much, they may use only the prior liability for the first quarter only. Then they wind up having to go to current year. So in essence, the wind-up is that for any kind of corporation making any decent amount of money is you wind up having to use only these two as your calculations for estimated tax payments, because you can't rely on the prior year liability the rest of the way. All right, those are the rules for estimated tax payments. Here's an example that they show you using the annualization method. You can work through this to see how it works out, and go through the book. I think they probably expound on the example maybe a little bit better there. Going through the example will just give you a better idea of what we're talking about. Then we come to alternative minimum tax. And I mentioned something at the beginning of this video that you'll see 2 reasons why we're going to go through this quickly, and that is we are not going to cover the alternative minimum tax for corporations at this time. It doesn't apply to small corporations, number 1. And number 2, it's usually calculated by most software systems. And number 3, most of us will not, in this classroom, most of us will not be dealing with C corporations on a day-to-day basis, and those of you who do will get involved in the alternative minimum tax at that time. So and it's rather complicated, and so for those reasons we're going to hold off doing that now. Should we wind up with extra time at the end of the semester when we get to Chapter 17, maybe we'll cover it a little bit more then. If there's an interest, anybody has a deep interest in covering it, let me know, and I'll be sure to put it in somewhere before the end of the semester. So that takes us through all these slides. And that ends the chapter. We're going to come back. I have a few more things to go over, and so I'll see you then.